his last money manager was trying to really like chase returns. And so you could see it that they would jump into asset classes after they've already taken off. And he reflected something that was really cool. And he said, I understand that when the market goes up, we're not going to capture all of it. We're not going to beat the market, but I was losing worse when things were down and I wasn't gaining as much when things were up, which is a really good sign of not being diversified the right way and not having the right mix of funds. What's really interesting is when you do experience market volatility or have fear of it, right? Right now, we're hearing a good amount of people say the market's hot. It can't stay hot forever. It's overvalued. We've been hearing a lot of these things for a couple of years now. And so there are certain money managers that their approach is going to be, we make decisions when that happens. We act. We decide to change up your portfolio. We are proactively deciding where the market is going. And some people really like that approach because it feels good to do something when you are feeling fear or anxiety about something. So I find when working with people, it is if they've had success, which would also be called luck in timing the market, then, they can feel like I'm not this, like I know what I'm doing. This has worked in the past. The trickiest is the clients who have made a bet and won on the bet. And then you mostly just have a discussion about overexposure, right? You made an amazing bet and it worked out for you. But does that one particular company now make up 20% of your portfolio? Some people, they are looking for that chase. They do feel that they need to beat the market to stay on top of their goals. They are going to be more in tune to an advisor that says, new idea, new flashy idea, new flashy idea. They're going to take that as they're paying attention. They know new information that nobody else knows. So it really depends on who that investor is and what type of experience they're looking for. At Curio, we believe the market is efficient. All of the information is baked into the market. There is no plan to beat it. We just want to capture as much return as we can. And so if a client understands that thought process, then they see the value, they've fought into it even during difficult times because they've seen the benefit, if they've been with us for a couple of years. If you're experiencing more volatility than you would expect for your asset allocation, which is just a fancy name for the amount of equities versus fixed income, stocks and bonds. If you're experiencing like really big swings, if it's feeling like you're invested in Bitcoin instead of the stock market, then perhaps you don't have as much diversification as you need, because when it wins, and sometimes that might result in wins bigger than the market, right? So if the S&P is performing here and you've got yourself mostly in tech stocks, as an example, there's been plenty of times in history where you'll perform above the market. But if you notice your range of outcomes are a much wider swing than what you're seeing in standard indexes like the S&P, then that gives you an idea that you are riding on a train that is a bit narrow in what its scope is. Because we've experienced that recently with the S&P, where we've got quite a few of the big players that are down, that have had very boring and consistent performance in 2026. But then because there's 500 companies in the index, a lot of the other companies have been able to pick up their slack. And then overall, the allocation gets you to a higher gain versus saying, I'm going to cherry pick these few performing stocks. And also, if you're reading independent pieces of information, I see that a lot where someone will read something about blue chip stocks and go all in on blue chip stocks. And then a new article will pop up and it will be talking to you about the energy sector, and they'll want to go all in on the energy sector. So those are kind of red flags that you're likely pinpointing these areas of the market, and then you're very much not participating in other areas. Our approach at Curio is a bit different. So we take advantage of down markets, and we can make sure we do tax loss harvesting and adjust portfolios, and we can do those other actions. But our job is to keep you in your seat, because when you look at the numbers, you're historically much better off if you can stay in your seat through volatility than try to predict the next move. It's ultimately really hard. If the investor is not bought in to the effectiveness of the strategy, then you're going to find yourself more fretful during those time periods. You're going to say, I knew this wasn't going to work. I knew the market was going to fall. I knew my advisor wasn't listening to me. So ultimately, when clients or individual investors shift their portfolio, it really is speaking to your confidence in the investment strategy. Because on the other hand, if you're going, I don't like this, but I understand I'm going to stay put, then you've probably been through a few market cycles. You've seen the benefits of staying in your seat during that time period. So it really comes down to individual experience and how much you can, stay strong during time periods that are very tempting to try to control. By having a set strategy right from the beginning, that's nice and diversified, and then revisiting that strategy, not based off of, what you think is going to happen in the market, but based off of actual movement, allows us to rebalance and constantly get you back to that target. And it really helps because that stops from chasing. We want to avoid chasing returns because, as we've seen, especially over the last few years, it can be quite unpredictable as to what happens to the market. And so sometimes it's not just the knowledge. You can have the knowledge, but the behavior piece can be really tricky.